Millions of tons of cargo cross international borders every hour. It is a continuous, physical flow of capital that never stops. In May 2026, the U.S. government announced that the national goods and services deficit had expanded by $23 billion in a single month, reaching a total of $77.6 billion. This is the official U.S. Census Bureau chart tracking that deficit. The blue line represents the monthly balance of trade. For most of the year, it traces a predictable horizontal path. Then we reach May, registering a $23 billion vertical spike. Financial media reports these figures as a scorecard of economic health, a static measure of what a country buys versus what it sells. But an aggregate metric of this size is a composite. To decode what a $77 billion deficit actually represents, we look past the top-line number, break down the corporate ledgers, and examine the obscure accounting methodologies. The national trade deficit measures the complex movement of capital logistics rather than the simple volume of physical shipping containers. We begin by splitting that $77.6 billion headline into its two primary components. The United States runs a massive deficit in physical goods, hitting $106.5 billion in May, which is partially offset by a $28.9 billion surplus in services. The sudden volatility in May came entirely from the physical side. The goods deficit expanded by $23.6 billion, while the services surplus barely registered a change. Drilling down into the goods ledger reveals a complex web of subcategories. The disruption originates here, inside industrial supplies and materials. Within this specific category, U.S. exports of non-monetary gold collapsed by $6.2 billion in a single month. That is a massive contraction of physical capital leaving U.S. vaults. But while gold exports fell, another crucial industrial supply moved in the exact opposite direction. Crude oil exports simultaneously surged by $2 billion. At the very same time, crude oil imports increased by $1.5 billion, creating a highly specific, volatile offset within the energy sector. Broad trade categories mask these intense commodity fluctuations. Professional macroeconomists isolate these specific asset shifts because they trace back to the behavior of individual market participants. Macroeconomic commodity flows represent the cumulative result of individual corporate capital allocations operating in real time. To see how this works in practice, we can use ExxonMobil, a multinational energy corporation with a $587 billion market capitalization, as our proxy. ExxonMobil's second quarter profit bump provides a clear window into these capital movements. Their earnings break down into distinct operational segments. Approximately $3.7 billion of that profit derived directly from stronger physical crude sales. But right next to it, the company recorded roughly $2.6 billion tied to derivatives on physical cargoes. These derivative trades are complex financial instruments. They represent offshore energy logistics and pricing mechanisms that heavily influence the aggregate ledgers, without necessarily moving physical product across a domestic border. For example, ExxonMobil managed global logistics by selling Nigerian Bonga crude to the Spanish energy company Repsol. That crude never touched U.S. soil. The capital flow originates from physical offshore production zones deep in international waters or foreign territories. When ExxonMobil commits $1 billion to projects like the Usan infill offshore platform in Nigeria, they are actively altering the future trajectory of U.S. aggregate ledgers through foreign direct investment. National trade balances reflect the real-time profit optimization strategies of multinational corporations rather than static political policy. This creates a severe accounting problem. If global trades happen entirely offshore, how does the Bureau of Economic Analysis track them to calculate U.S. GDP? The baseline data comes from U.S. Customs and Border Protection. In economic reports, this is formally known as the census basis, but census basis data is strictly limited to physical goods crossing the geographic borders of the 50 states and territories. To capture the complete economic reality, government economists apply a second layer of accounting, known as balance of payments, or BOP adjustments. These BOP adjustments are legally required to bridge the gap between physical border crossings and the actual national income and product accounts. One of the most critical adjustments is called merchanting. This occurs when a U.S. entity buys a product abroad and resells it to another foreign country, keeping the entire physical transaction outside U.S. borders. Because the cargo bypasses customs entirely, the financial profit generated by the U.S. corporation must be manually calculated and added to the BOP ledger as an export of goods. The same logic applies in reverse. When U.S. carriers purchase fuel in foreign ports, transactions bypass domestic customs, but must be added to U.S. imports. True macroeconomic measurement relies on the legal transfer of financial ownership, regardless of the physical shipping path of the box. Global trade is inherently turbulent. Massive shipments of gold, fluctuating crude derivatives, and offshore merchanting all create intense monthly statistical noise. Returning to the Census Bureau chart, the blue line's $77.6 billion spike is driven by isolated commodity anomalies. To find the actual trajectory, analysts focus on the orange 3-month moving average. This smooths out extreme volatility, settling at a stable $62.9 billion trend for May. That $62.9 billion figure is the true indicator that professional macro analysts use to model growth and forecast the broader economy. Arriving at that number requires meticulously balancing physical customs declarations with invisible offshore economic transfers. The national trade deficit is a synthesized reflection of transnational capital logistics, accounting for financial complexities that occur far beyond the domestic shoreline.